Today on Retiring Well with Centennial Wealth Advisory, we'll talk about today's low interest environment and how it affects yields of traditional types of investments.
How do you get yield, or said another way, decent interest rates on your fixed money in today's interest rate environment?
Coming up, we'll discuss a very attractive alternative that provides up to 5% guaranteed lifetime income and principal protection.
I'm going to give you alternatives. I'm going to give you options. I'm going to share with you what might make more sense.
All this and more on Retiring Well with Centennial Wealth Advisory, starting right now.
Retiring Well with Centennial Wealth Advisory, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Centennial Wealth Advisory, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and I'll tell you what, we have got a terrific show lined up for you this week. We are talking about interest rates and, quite frankly, asking the question, how do you get yield, or said another way, decent interest rates on your fixed money in today's interest rate environment? How in the world do you do that? Because let's be honest, interest rates are really, really low, and that means our traditional tools like bonds are not paying very much. In fact, a little bit later, I'll show you exactly what they're paying in today's interest rate environment. So the question is going to be, what do you do? Now, let's talk about some of the challenges we're having with bonds right now. This is pretty important. Now, one of the things that we need to know about bonds is that bonds have two jobs. So in a portfolio, bonds have two jobs. Job number one is to provide ongoing income. In other words, one of the reasons you put money into bonds is to provide ongoing income. Traditionally, a balanced portfolio has about half of the money in stocks and half the money in bonds. So what are the bonds doing? They're paying income to the portfolio. Stocks provide capital gain, bonds provide income. Well, that's job number one. What's job number two? Job number two, stability. Think about that 50-50 mix. Bonds are traditionally pretty stable. Stocks, well, to say not so stable would be an understatement, wouldn't it? Stocks go all over the place. So the purpose of bonds, the second reason we use them, is to provide stability. Well, let's think about where we are today with that. Job number one, pay ongoing income. How much income are bonds paying these days? Quite frankly, not a lot. As I said, I'll show you exactly how much in a couple of minutes. What about stability? Well, here's a little piece of information that not everybody knows. Bond values and interest rates, they are on opposite sides of a teeter-totter. So when interest rates go up, bond values go down. When interest rates go down, bond values go up. Well, interest rates right now are very, very low. So when interest rates go up, you've seen the Fed starting to increase interest rates. When interest rates go up, what happens to bond values? They actually go down. So think about this. Right now you've got bonds that are failing job number one. They're not paying much interest or much income. And they're failing job number two. They're not providing stability to a portfolio. As a result, people are drifting away. And now a lot of folks, maybe you're one of them, you may find your portfolio taking on a lot more risk than you ever thought you were taking. So let's take a look at where interest rates are today with bonds. We start with treasuries, and now on the screen you're seeing 10-year treasury rates, 20-year treasury rates, 30-year treasury rates. Look at these numbers. Now look at the 10-year rate. It's less than 2%. Now think about that. Do you want to loan, because a bond is a loan, do you want to loan your money to the government? And for 10 years, lock your money up for 10 years and end up getting less than 2% in return? I don't think so. Not a good deal for you. Great deal for the government, but not for you. I mean, look at 20 years. Look at 30 years. You want to know why 30-year mortgages are so cheap? Look at 30-year government bonds. They're below 3%. My goodness. Who in their right mind puts money in those types of instruments? And so what do? We look to the corporate side where we start taking on risk, because what happens if the company goes bankrupt? Your money goes away. And if you loan money to a company that goes bankrupt, that's not good for you. But let's take a look at those rates. 10-year government bonds, 10-year corporate bonds rather. You're getting a little bit better. You're getting maybe 2.5%, 3%. What about longer term, 20-year? Now we're getting 3.5%, 4%. We're starting to get some better rates. But you got to tie up your money for 20 long years just to get there. Folks, this is why people aren't putting money in bonds. They're just not attractive. But you know me, I'm going to give you alternatives. I'm going to give you options. I'm going to share with you what might make more sense. So I don't want you going anywhere. Coming up after the break, I'm going to share with you personal pension plans and the role that they might play in your overall planning in today's market.
Let's talk about retirement income in today's economy.
Do you have a plan for your retirement? Are you concerned about Social Security and tax decisions coming from Washington, D.C.? Is the extreme volatility of the stock market causing you to worry about your retirement plan? If the answer to any or all of these questions is yes, then we would love to meet with you. We at Centennial Wealth Advisory would love to sit down for a no-obligation look into your own personal retirement plan. Please give us a call at 512-265-5000.
Do you have questions about your retirement income planning? We have answers. Give us a call right now at 512-265-5000 to talk to our retirement strategy team. Again, that's 512-265-5000. It's free to talk and we can help. 512-265-5000.
Essential financial strategies for a comfortable retirement. Join TV host and certified financial planner Michael Reese for an informative and exciting presentation with complimentary gourmet dinner, and learn how to protect your assets from market volatility, how to find growth and security in today's volatile market, how to prevent outliving your money, how decisions in Washington, D.C. are affecting your retirement, how to safeguard your assets from unnecessary taxation, the 4 ways to make sure your advisor is giving you expert advice, and much more. Choose the date and location that works best for you. Wednesday, April 6th or Thursday, April 7th at Steiner Ranch Steakhouse in Austin. Wednesday, April 13th or Thursday, April 14th at Texas Land and Cattle in Cedar Park, or Wednesday, May 25th or Thursday, May 26th at Gumbo's North in Georgetown. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
Welcome back. This week we, of course, are talking about how to generate retirement income or yield from a portfolio in today's interest rate environment. And in our last segment, we looked at interest rates. We saw that they're really low. It's hard to get decent income from really any type of traditional interest rate type of bond or government bond, corporate bond, what have you. So we need to look at alternatives. We need to expand our horizons and say, okay, what else is out there? Are there any other items that might be helpful? What I want to do in this segment is talk a little bit about things called private pension plans. Now, a lot of people are familiar with pensions. You might be familiar with pensions. Maybe where you worked there was a pension, or maybe you know someone that has a pension. And the way a traditional pension works is you work for a company or you work for the government. And when you retire, they give you some stream of income that is guaranteed for your lifetime. Well, the good news is that today you can create your own private pension plan, and a lot of times you can do it in a way that gets rid of all the negatives of traditional pension plans. What don't we like about traditional pension plans is usually when you die, the income stream stops and there's no money left for heirs. Well, what if you could create a private pension plan where you had income for life, but you still protected your principal? Now that would be a neat little trick, and that's what I'm going to show you how to do. So here we have, in my little circle here, let's imagine that this circle represents all of your retirement savings. So here are your retirement savings. And you think to yourself, you know, I would really like to have a chunk of this in some type of bond alternative, something that generates income. And traditionally, in the ideal world, you might say, you know, now that you're retired, you might say you want maybe 40 or maybe 50% of this in fixed income. You're just not putting it there now because you can't find any fixed income that pays you anything. And hey, I totally understand that. But let's imagine that you chopped out, you know, 40 or 50% of this, and you put it over here into one of these private pension plans. And in today's world, let me share with you, if you design it properly, what you can expect to receive if you do this the right way. First of all, one of the things is, depending on your age, you can generate 4.5% to 5% guaranteed lifetime income. So in other words, what that means is, if you could basically have whatever you would normally put in fixed income like bonds, imagine you could go buy bonds today that would pay you 4.5%, 5% guaranteed for as long as you live. I mean, how much of your money would you put in a bond if you could protect your principal? How much money would you put in a bond that would guarantee you 4.5%, 5% for the rest of your life? You know, it's interesting when I talk to people that have a little bit more money, you know, north of $1 million, it's very common. They'll say, gee, if I could get 4.5%, 5% guaranteed yield or cash flow and protect my principal, I'd put all my money in that. Well, I don't think it's a smart idea to put all of your money in any one thing, but nevertheless, 4.5% to 5% guaranteed income for life, and it depends on your age. Next, what else can you get? You can protect your principal. That, or principal AL. Protect your principal. That's important. Imagine that. Why do you use bonds? I mean, think about fixed income traditionally. If you could go out and buy bonds that paid you 4.5%, 5%, guaranteed your principal, and it was all guaranteed for the rest of your life, would you do it? That's what these things do. Private pension plans allow you to do that. Now, heads up, private pension plans, in order to make this happen, typically they're run by insurance companies. They're using special types of annuities, usually a combination of annuities. You absolutely have to do it right. You can mess this up real easily. But here's the thing. If this type of an approach, if you're saying, man, that looks interesting to me, if that's what you're thinking, wouldn't be a bad idea to give us a call.
Let's talk about the diversity of your retirement portfolio.
Nowadays, you always hear you need to be diversified. But what does it mean to be diversified in a portfolio? It means to hold assets that aren't correlated to one another. This allows you to narrow your range of returns while not decreasing your average return. This is paramount in retirement, especially when you're taking income. Holding 200 different stocks does not mean you're diversified, and holding 30 different mutual funds does not mean you're diversified. To find out how diversified your portfolio is, give us a call at 512-265-5000 and talk to one of our advisors about a free, no-obligation portfolio analysis.
Do you have questions about the diversity of your retirement savings? We have answers. Give us a call right now at 512-265-5000 to talk to our retirement strategy team. Again, that's 512-265-5000. It's free to talk and we can help. 512-265-5000.
Essential financial strategies for a comfortable retirement. Join TV host and certified financial planner Michael Reese for an informative and exciting presentation with complimentary gourmet dinner, and learn how to protect your assets from market volatility, how to find growth and security in today's volatile market, how to prevent outliving your money, how decisions in Washington, D.C. are affecting your retirement, how to safeguard your assets from unnecessary taxation, the 4 ways to make sure your advisor is giving you expert advice, and much more. Choose the date and location that works best for you. Wednesday, April 6th or Thursday, April 7th at Steiner Ranch Steakhouse in Austin. Wednesday, April 13th or Thursday, April 14th at Texas Land and Cattle in Cedar Park, or Wednesday, May 25th or Thursday, May 26th at Gumbo's North in Georgetown. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
Let's talk about the unexpected risk you may be taking with your retirement savings.
Volatility in the markets is one of the biggest challenges that retirees face as they're taking income from their portfolios. Oftentimes, people think that they're taking this much risk when they're really taking on the full risk of the market. If you're interested in seeing how much risk your portfolio currently contains, please give our team of advisors a call here at Centennial Wealth Advisory, and we'll provide you with a free, no-obligation review of your current investments. Please give us a call today, 512-265-5000.
Do you have questions about the risk you are taking with your retirement savings? We have answers. Give us a call right now at 512-265-5000 to talk to our retirement strategy team. Again, that's 512-265-5000. It's free to talk and we can help. 512-265-5000.
Welcome back. This week we are talking about this low interest rate environment and how in the world do you get decent yields or decent income from fixed income types of instruments. We talked about bonds, corporate bonds and government bonds, how 10, 20, 30-year bonds, they're just not paying anything. So next we looked at this idea called a private pension plan, or some call it a personal pension plan. And the idea there is you work with an insurance company, and if you do things right, you can generate 4.5%, 5% income while still protecting your principal. So that might be a solution. But here's what happens. And I know what happens because people come into our office every day. Maybe it's someone like you. Maybe like you, they were watching the show and they said, I want to go in and talk to those guys. And so they call us up and they come visit. And here's what we hear. They say, you know, I'm not a big fan of the interest rate environment. I don't like bonds, and hey, for very good reasons. They say, here's what I do. I go out, and usually they puff out their chest a little bit, and they say, I own high quality stocks that are dividend paying stocks. So that way, I get some price appreciation on the stock, and I get my dividends, and even the dividends grow over time. And that's my plan for retirement income. And normally when people say that to us, they're very proud of it. And that's fine. And guess what? The last 7 years, since March of 2009, the market's been going up, up, and up. And that approach, quite frankly, can work very nicely when markets are cooperating, when they're going up. Here's a problem, though. Do markets always go up? They don't, do they? Sometimes markets go down. And when they go down, they tend to go down fast. And when they go down, these high dividend paying quality stocks, bad things start happening, and they happen fast. I have some examples for you from 2008 of what happened then to people who were retiring and they were basing their retirement income on these dividend-paying, high-quality stocks. And by the way, we all have short memories here. I was an advisor through this period, so I had people coming to us every day telling these stories of what I'm about to share with you. This happened to real people just like you every day. I'll start with General Electric, big company. In 2007, they were trading over $40 a share. By the end of 2008, they were $6 a share. It's almost, 85% of the money gone in a year of the account value. Dividends went from 31 cents a share down to 10. 2/3 of the dividend income gone, and if you weren't happy with it, hey, congratulations, we'll let you sell out of your position and take an 85% loss. Next one on the list is Altria. Now these are the people that make Philip Morris, the cigarette company, they own Kraft Foods. Yeah, they were above $80 a share. A year later, below 20. 75% of the value gone. Dividends, 75 cents a share, reduced down to 29. Same story, 2/3 of the income gone. If you didn't like it, fine, sell the position, take an 80% loss. And then the last one, Bank of America, solid as they come. They went from over $50 a share to 90% gone in a year. Dividends, look at this. They were paying 64 cents a share dividends. Within a year, it went to one penny. 64 cents to 1 penny. How do you think the people that were invested in those companies, and by the way, pretty much any other company paying dividends at the time, how do you think those people felt about their retirement security when their portfolios were just crashing and their dividend income went down? Income that's never come back. That's why you cannot count on dividend income paying companies for your retirement security.
Let's talk about retirement income in today's economy.
Are you using your savings for retirement income? Are you worried about outliving your money? If so, you're not alone. In fact, that's retirees' #1 concern, even more so than dying. And unfortunately, in 2008, we know that if another market crash happens, a lot of folks' concerns out there will become a reality. Here at Centennial Wealth, we specialize in retirement income planning. So if you would like us to give you a portfolio analysis to see how your plan stacks up when the next market correction happens, give us a call at 512-265-5000.
Do you have questions about your retirement income planning? We have answers. Give us a call right now at 512-265-5000 to talk to our retirement strategy team. Again, that's 512-265-5000. It's free to talk and we can help. 512-265-5000.
Hi everybody, I want to introduce you to my new puppy Banks here. For those of you who've been watching the show for a while, you know that I had a dog, Charlie. He was our guru, but then he had to kind of go away. So my wife got me Banks. She's a little 8-week-old Bernese mountain dog, and today we're welcoming her to the show, and she's going to pick a stock, find out if she's a better investor than Warren Buffett. This is going to be fun. All right, so I told you that we are going to have Banks pick a stock, and we're going to compare how she does to how Warren Buffett invests. And Banks is she's only 8 weeks old, but she's already spent her entire life looking at the stock market, really identifying which ones she wants to look at buying versus others, and she's narrowed it down to 4 companies. So here we go. First, we've got Apple. So that's one of the stocks she's going to consider. And the reason Apple is because when I first got her, I took a picture of her with my little iPhone, and she's so impressed with technology. She's like, we got to check that one out. The next one, well, of course it's Disney. What can I say? I let her watch Lady and the Tramp. And since then, she thinks the world of Disney. So she thinks that's got to be a winner. Next one, Exxon. Well, why? I was driving her in the car, and she's like, man, look how cheap gas is. I bet prices are going to go up. I think Exxon's going to make some money. So that's where that one came into play. And then the fourth one that she liked. Well, it's obviously Nike because let's be honest. What dog doesn't like to chew on Nike shoes, especially puppies? So there you go. Here's what we're going to do. We're going to take these 4 papers. I'm going to lay them on the ground. And what I'm going to do is I'm going to put like little dog treats on each one of them. And then I'm going to bring in Banks. And whichever one she decides she goes to first, so whichever treat she eats first, that's going to be the stock that we pick. And then what we'll do is we're going to kind of compare that over the next couple months with what Warren Buffett does with Berkshire Hathaway, and we'll see, who's the better investor. Warren Buffett, 80-year-old Warren Buffett who knows the Oracle of Omaha, or my 8-week-old puppy Banks. This is going to be fun to see how this works out. All right, so here we go. We've got our 4 companies, Exxon, Apple, Nike, and Disney, all laid out. We've got dog treats, as you can see in each one of them. And what we're going to do is we are soon going to release Banks. Now, remember, Banks, she's only 8 weeks old. She's going to come. She's going to, whatever dog treats she eats first, that's the stock she's picking. And we're going to measure her performance over the next couple months against Warren Buffett. So with that in mind, I hear she's ready to come. Banks, come on over. Let's pick a stock. Oh, look at this. She thinks Nike. Banks is really excited. Banks looks pretty excited about all these stocks, let's be honest. But this little girl, she thinks Nike is the stock to be in. So apparently chewing on shoes. That's the way to go. She's thinking if she chews on enough shoes, people will buy them and it will make the stock price go up, I guess. Wow, you're doing great. Anyway, so what we're going to do is we're going to take Banks' stock here, her pick of Nike. And here we are when we're recording this, it's right at the beginning of March. So we're going to look at what the stock price is of Nike. We're going to look at the stock price of Warren Buffett's Berkshire Hathaway. And we're going to, she's getting a little crazy here. We're going to compare how they all do between the two of them over the next couple months. And we're going to keep you posted. And probably the next time you see Banks here in a month or so, she'll have grown a little bit. So as I said, she's only 8 weeks old, and next time you see her, she'll probably be a little bit bigger. So Banks, good job, and folks, we'll keep you posted on this project here.